Hi everyone, Joe here. It is time for another thrilling installment of Patreon question Q&A, where my Patreon members ask questions and I attempt to answer them based upon my 28 years of trading in the market, including a few years with Mark Minervini's private access. And if you want me to answer one of your questions, I considered joining my Patreon. There's a 7-day free trial. Link in the description below. Before we begin, remember this is not investment advice. This is just for education, for entertainment purposes. You need to make your own investment decisions. Invest at your own risk. Let's look at the first question. Here's a question from Rick regarding struggling with entry points. He says, "Hi Joe, I struggle with timing an entry point on the day I'm looking to make the trade. Whether it's price action off a moving average, low cheat, or a traditional breakout, I tend to hesitate watching the 1-minute chart. Maybe I should use buy stops to take my emotions out of the trade. I think I've heard Minervini say that the entry does not need to be the lowest price, but the right price. Do you have any suggestions or guidelines you use on the day you're looking to enter the trade?" So on the plus side, I like that you know about low cheats and not just the O'Neill traditional breakouts, but it sounds like you are getting paralysis by analysis and you are getting, it's good to be surgical, but it seems like you're getting too surgical on trying to nail the breakout at exactly the breakout point. So a few things here. First of all, during my time with Minervini, he addressed entry points over and over and repeatedly said that he rarely looks at anything on a shorter time period than the daily chart. He finds a good-looking pattern with volatility contraction characteristics with a nice tight pivot area to trade off of, and then when it breaks out, he buys it, and he doesn't dial down into the 1-minute chart to try to get the exact closest entry point possible. He did say that occasionally he will look at an intraday chart, but when he does so, he looks at a 5-minute chart. The 1-minute chart is too noisy. In reality, as long as you're within a couple percent or so of the breakout point, in my opinion, you're good, because there are times when most breakouts are working. There are times when most breakouts are not working. And when you are in one of the easy dollar environment times like we're in right now, most of the breakouts, if you're buying out of a good pattern, are going to work, and you don't need to be so obsessed with getting, being 1/10 above the breakout point. What you need to do continuously is be looking at a large body of bases and watching the breakouts, particularly in the industry of the stock. Either most of them are working and extending multiple days, most of them are squatting and then working a few days later, or most of them are reversing on the breakout day or the next day, pulling back into the pattern, sometimes even blowing through the bottom of the pattern, like we saw in 2022. When they're working, then be more fatalistic. Don't worry about the patterns on the 1-minute chart. When the stock breaks out, buy it. And if you miss it, if it's extended, 3 or 4 or 5%, then wait for the next day. A lot of times the price will come right back in a percentage or two before it begins extending. Regarding using buy stops, I think for people who cannot be in front of the computer, when the market is healthy, I think buy stops are an excellent idea. Now, if it's a really spready, there's a wide gap between the bid and the ask, you'll need to do a buy limit order. If it's a large cap like Apple or something, then you can just do a market order. Now, you don't want to do buy stops when the market is really whipsawy or a bear market. You're going to want to wait and see if those breakouts extend. During 2022, when I was buying breakouts, I was waiting till the end of the day to see whether it was going to squat or not. And yeah, Minervini often talks about buying at the right price. not the lowest price. What he looks for is tight areas where the volatility has contracted. Here's an example, CDRE. He waits for an area like this. See how the volatility goes from large to medium to small to really tight? So then you can buy the breakout, say right here, and you only have to be, it only has to pull back, look at that, about 4 or 5% for you to know that it is behaving abnormally. Now, could you have gotten in earlier, somewhere down in here? Absolutely. But you have all of this supply, you have all this random price movement, and where do you set your stop? You know, there's no indication here that supply has come out of the market, and it would be really difficult to set a stop other than an arbitrary, mathematical 5 or 10% stop. So yeah, believe me, with breakouts, there's always something technically or fundamentally to worry about, but when the market is strong, like it is right now, the majority of the patterns are working, just buy the breakout, set your stop, be fatalistic, wait and see what happens and give it the benefit of the doubt. Particularly big caps, sometimes they take quite a while to launch. For example, here's GE. When I bump this to an overweight position, here's a little saucer pattern and a cap. Here's my breakout buy, and I just bought this off the daily chart, this chart right here. And then it took 1, 2, 3, 4, 5, 6, 7, 8, 9, 10, really 11 days before it started working in earnest. So that's the other thing, is to just be patient. And I guess the last thing would be, just to elaborate on, look at what the industry is doing. Birds of a feather flock together. If several stocks in that industry have already broken out and are working, chances are the breakout you're looking at is going to work too. Let's just look at the home builders. Here's the MTH, big breakout, continued to work. Here's Toll, big breakout, continued to work. Here's PHM, big breakout, continued to work. Those charts look almost exactly the same, so you can buy those breakouts with confidence. Let's look at the next question. Okay, here's a question from Matt. Hi Joe, hope you enjoyed your vacation. I sure did. Let's see, couple questions. I know nothing about either of these companies, but they popped up on a couple custom screens. Have a great one. So he's asking about TIPT, insurance company. What a daily bar today. This was on January 8th. Let's take a look at it. Let's see, TIPT, T-I-P-T, is in financial services industry. It's insurance policies, real estate, specialty finance products, has a 1% dividend. It's always nice to see a little dividend. Profitable company. Insurance and industry is ranked 38 out of the 200 or so industry groups on MarketSmith. I know insurance companies have been hot for quite a few months now. Looking at the earnings and sales, decent, not great, 21%, 15%, 100% gross margin. I don't know that that is correct. I'm going to disregard that. Looking at the monthly chart, it's definitely in stage 2. It had this really long, gosh, how long is that? Decade-long base, broke out, and now it's in stage 2. And you've got a pretty nice trend channel. It might be wedging just a little bit. That's a pretty good trend channel. Let's go back and look on stock charts again. You were commenting about this huge move on 1-8 on huge volume. Love the volume here and here. So was that a great entry point? Is it extended now? Yes. This is a stock I would love to be in, but not a stock I would want to be buying right now. You've got a cup here. You've got a little bit of a handle, a decent little handle. I really like the buy point right here. And then it ended up coming back in on the broader market, vaulted off the 200-day. I would have considered buying off the 200-day, but this is probably an earnings move, and it's not quite in a steep enough incline for my taste. But it did give you a tight little pivot area here. You could have put on a position right here. And then it did give us a little bit of a high tight flag. We can call this a bit of a high tight flag. Let's see how tight that is. Yeah, that's actually pretty nice and tight, and the volume came down, as you can see. So that actually would have been a pretty good buy point right here. Now, if you're not already in it, it is definitely too extended, because you are, if we call this the most recent base, real base, we are a solid 20% off of that base, and it is 10% off the 50 days. So I would definitely wait for it to come back and get close to the 50-day again, or set up with another tight base area like that. RXST. Boy, I was having trouble saying that. RXST medical products, 125th out of 197 industry groups. This is a great looking weekly chart here. Here's your primary base. Wait a minute. Here's your MarketSmith. I love MarketSmith, but the annotation tools are really leave a lot to be desired. Here's your primary base. Really nice breakout. Came back in, tagged up with the 200-day. Got another base here. Yeah, it's probably, I'm probably going to say it's too extended. But let's just look at it a little bit more, and then we'll go to stock charts. Develops and markets intraocular lens for every unique eye after cataract surgery. That's an interesting niche. It is not a money-making company yet, although, I mean, Amazon, for example, went up for years before it made money. Let's see. It is selling its product, and it has strong sales, 76%, 196, 83, 76. We want to see that accelerating technically, but those are really good numbers. Gross margin, not that impressive at 62%. Let's look at it on stock charts. Here we are on stockcharts.com again, and here is that primary base, kind of a double bottom. What a great spot to buy right there. And let's zoom out to the 1 year chart. Here's the latest base. Did give us a little cheat area there. That would have been a great spot to buy. Actually, right here, you could have justified it. And also, I mean, honestly, when it crossed this ascending 200-day, when a stock comes down to its 200-day moving average, simple moving average, if it is in a pretty strong uptrend, which it is, usually the 200-day will catch it as the institutions, because that's where they like to load up, on the 50-day and the 200-day. Buy here, buy here, buy here. Did not give us an O'Neill handle. Came back in with the broader market. Gave us a little tiny pivot area. I personally would not have bought that coming right into all of this supply here. Powerful breakout, and now it's too extended. So now, hopefully you're already in it. If you're not already in it, we're sitting 45% above the 50-day. Personally, I would just let this one go at this point. Wait for it to set up again. Wait for it to give you at least a couple week tight pivot area like this to trade off of. And then let's look at DHI. He was wondering if DHI was extended. This will look at 1/8, January 8. Price action looks a little wonky or jittery to me. Seems like it has big move days, then inside or small move days. Is this normal? Well, before we even look at it, different stocks have different personalities, and it also depends on the market cap of the stock. Some of the small caps can be really jittery and gappy and have a large spread between the bid and the ask. A lot of the mid-cap companies are the ones that really make nice, tight, attractive patterns like the ones you see in textbooks. And then big caps do not move as much per day, but they tend to make V bottoms and malformed bases that often don't give us a handle, which is why we have to get in at a cheat. But let's look at DHI. Yeah, DHI is one of the home builders, so right away I'm going to say really strong industry. I like this one in principle. 19 out of 197. There's a shortage of new homes because for about a year and a half during COVID of 2020, they did not build. Home builders were pretty much shut down, and we are still working off that backlog. This company makes a ton of money per year, has a little dividend. Numbers, earnings have actually come in. Sales are tepid, so based upon the numbers, this would not be a buy, but the stock is trading off of future guidance and expectations. Nice monthly chart, had a long, decade-long base, and now it is firmly in stage 2. Here's a nice looking base, broke out, pulled back, and now it is extended. Was it extended on January 8th? Right there. So certainly you are late to the party, but given the fact that we are in an early stage bull market, given the fact that these home builders are essentially red hot, given the fact that it is just coming out of a general market pullback and it barely pulled back, I would actually have been comfortable putting on a half position here on January 8th and even putting on the rest of the position the beginning of the day, January 10th, with a stop probably right here at 145. Now this is certainly aggressive. It's quite a bit extended above its 50-day. A much better buy point would have been off of this little handle right here. We had the left side of the cup, we had the truncated right side. Many stocks have these truncated right sides of bases this year, which ordinarily you want to have symmetry, that you want the right side to look like the left side, but the majority of stocks made these truncated bases. And if you look at the SPY, let's just look at the SPY. Look at this, same truncated base, big breakout, and it's working. So you got to look at the theme, not just what the textbooks say, but you got to look at the theme of the market. Here's our ideal buy point right there. If you're not in already, oh gosh, if it just opened a tick or two higher, I still would be comfortable, but I definitely do a smaller than normal position. And then ideally, let's wait, and then the first time when it sets up a longer base and gets near this 50-day, then that would be the next opportunity to really load up. Okay, David Taylor. Joe, I'd be interested to hear what you think of APP. Looks as if the weekly is positive, long consolidation, but on the daily it has some overhead resistance. If it breaks out of this range, it may be interesting. And this was actually today, January 11th. Let's see, let's start on MarketSmith. App 11, computer software, industry ranking is 127 out of 197. That is kind of in the mid-range, so to speak. Relative strength of 98, that's really good. Newly profitable company with a big earnings jump from negative to positive $3 in 2023. Let's see, the weekly shows a really nice protracted downtrend in 2022, like pretty much every growth stock, but a nice uptrend now, and really a nice long base. It's almost getting too abnormally long. I'd like to see it break out soon. No dividend. Let's jump over and look at stock charts now. Okay, here's a 1-year chart on stock charts. Long downtrend coming down over here. Big up move, and now here's this base that we're looking at. Yeah, if it breaks out of this base, it will be interesting, like you said. It really is taking longer than would be ideal, in my opinion. We got this big volume sell day here. The first time it tried to break out, tried to break out and squatted here. Now eventually, if it keeps testing 44, all of that selling pressure is going to dry up. All of those shares will eventually come to market. Starting to turn back up. I personally wouldn't buy within this pattern, but you certainly could set. Personally, what I would do is I would set an alarm at, say, 45, an alert, and then I'd watch it, and I'd want to see it close at an all-time high, not just because it's squatting. I wouldn't want to see it just break through 44, but I want to see it close above, let's see, 1 second. I want to see it close above 45.10. Let's see if the volume's giving us any clues. I really don't like that, as well as we mentioned. Here's some nice buy volume. The last time it tried to make this run, the last couple of days it's had some pretty nice buy volume as well. But like I said, I don't like to buy within a base like this. You can get stuck sliding sideways for months, and that is no fun when there's no dividend. Now here, I'll even show you what I would like it to do. So let's just draw this in. What we want to see is we want to, let me get rid of those dots. We want to see it run up. We want to see it run up to the lip line. I don't know why I'm having so much trouble doing this. Let's see it run up to the lip line. And then we want to see it tighten up. Oh, I see. I got to double click. Tighten up. Tighten up. Maybe have a little shakeout like so. Okay, so we want to see it tighten up, give us a little shakeout, and then a breakout. That's what we want to see, and then that is when I would feel really good about buying it. Okay, and here's a question from JJ. Hi, Joe. Happy 24th. Happy 2024. I recently joined MarketSmith and was wondering, how does O'Neill differ from Minervini, Mark Minervini, two-time U.S. investment champ? It appears O'Neill considers pivot points to be above the level of the cup, the lip line, and Minervini likes to buy at a lower cheap price. I've discovered that I'm actually doing a bit of both and have actually been selling into strength at the very place MarketSmith is saying to buy. All right, so how does O'Neill differ from Minervini? Okay, so off the top of my head, there's a handful of differences. One, William O'Neill was very much a believer in fundamentals. He wanted to see accelerating earnings growth, accelerating sales growth, accelerating margins, in addition to a strong technical pattern, whereas Minervini often trades technical patterns, companies that are pre-revenue and don't even have any sales and earnings, or companies with spotty sales and earnings coming out of a strong technical chart. He's often said that the fundamentals are icing on the cake. It's great if you have strong fundamentals, but he'll buy the chart anyway. That's the first distinction. Secondly, Minervini primarily buys out of tight pivot areas where you see some volatility contraction. If we go back, so if we look at NVIDIA here, he looks for this volatility contraction where you've got, in this instance, you've got large contraction, medium, small, and then he buys the breakout. Whereas O'Neill would say, you know, here's your double bottom, and here is your tip of the V. You buy right here. So you just buy above the breakout points in a double bottom or a cup with handles. So Minervini's much more surgical. So he passes on a lot of breakouts because they don't show volatility contraction, and therefore misses some of the big winners, but he definitely controls his risk more than the traditional O'Neill trader. And also then in that regard, O'Neill talks about having a 7 or 8% sell stop, whereas Minervini averages about 4.5, and he does a lot of staggered stops, maybe a 3.5 and a 7, or a 4 and an 8, etc., depending on support lines. whereas O'Neill generally just talks about using one stop. Progressive exposure is another big Minervini thing where you vary the size of your bets, so to speak. Progressive exposure. So you increase the size of your opening positions when you're doing well, decrease the size when you're doing poorly. I do not remember O'Neill talking about that. And then, like you said, Minervini ideally likes to be in a position before it breaks out. So if we look at Belle-Fuse here, it's kind of an ugly cup, but it is a cup. Minervini would like to get in it down here at a chi area, whereas O'Neill would you'd be buying up here. And you said that you are selling into some breakouts. It really depends on, you certainly can do that. You're going to be flipping the coin much more than you would ordinarily. I think in an early stage bull market like this, a better way to do it would be to just sell half or a third and try to hold the rest of the piece through the breakout and beyond. Now, in a whipsaw market, buying at a low cheat or cheat and then selling into the breakout is an excellent method. So you want to tailor your sell points based upon the health of the market. Let's see, you talk about MPC and OKE, which I've owned for months, triggered my sell limit, which was Marcus Smith's blue buy box. Appears Marcus Smith is geared at high growth stocks, not necessarily value or cyclical type stocks. Yeah, so Marcus Smith is based on the CAN-SLIM system, which is all about buying growth stocks. That is true. Let's look at MPC. I'm not sure where you sold, but you probably sold into it right here or somewhere along there. So if you sold here, in this instance, you did the right thing because it came back into the pattern. But right now, on average, breakouts are working. Now, this really is not a great breakout because you don't really have a tight area, and you can see it's extended 7% from the bottom there. So it would make sense that it would pull back into the pattern. And I'm not sure where you bought on this crazy thing, but let's just draw in what we'd want to see. We just want to see it stay tight here. Stay tight and stay tight, and then break out, and then it's going to hit the supply, and it's probably going to make a cap like so. And then when it breaks out for real, that's when you could re-enter. Or if you were already in it, that's where you could double your position. Yeah, MPC is a refining stock, which is cyclical, although it's been in a strong 4-year uptrend here, 3-year uptrend. Let's see, OKE triggered your sell limit. Gosh, I have no idea where you entered this one, JJ. You got kind of a cup here. I suppose this is a decent handle right here, so you could potentially have bought right there, but then I personally would have gotten shaken out on this pullback. Well, maybe not. 8% pullback. And then, yeah, it blew through this. It blew through the slip line, but you don't have any tightness here. This is so wide and loose. I certainly don't see a place to buy here. If you had bought here, then yeah, you could sell into one of these breakouts. But as you can see, the trade's working. You're starting to get, hold on. Let's pick a different color. You're starting to get a little bit of a trend channel here. It is contracting a bit. You don't want to see it funneling like that. Yeah, pretty messy chart though. Personally, I'd like to see you move into stocks that are not so wide. OKE, let's hold on here. OKE is a natural gas stock. It does give a nice 5% dividend. That definitely makes it more attractive. For fun, let's look at one of these stocks with my partner, Seeking Alpha. Let's look at APP, a tech stock, software stock. I really like Seeking Alpha. One, it has this real-time updated portfolio. You can build portfolios and watch them during the day. It has tons of fundamental analysis, fundamental information, news items, transcripts, and I particularly like reading these analysis articles. When I find a strong-looking chart, then I will go to these articles and learn more about the company. Let's just click on one here, AppLovin, new AI ad engine set to power results. So it's using AI to power an advertising engine. And then we have a summary here and rationale for why it is doing well. And if we read a handful of these articles, we could get a varied and rather comprehensive opinion on why the stock is doing well. I don't buy stocks based upon these articles. I find strong charts and then use these articles to determine the long-term hold potential of a stock. And then I use the news items. And I also like to read the quarterly transcripts when they come out. If you are interested in Seeking Alpha Premium, I have a link in the description of this video. And that's where I'm going to wrap it up today. Thanks for your questions, Patreon members, and let's do another one soon. Take care.